you so much for everybody coming. My name is Brad Rathe. I know most of the people in the room. I've done a state of the markets for the last probably 8-9 years. I did it to this group and a bunch of groups all around Chicago. I really just wanted to try something different, and so we really hope you enjoy tonight. We have a great group of panel. I'm going to introduce a couple of people up here tonight. Let me take a couple housekeeping things. The cameras are for us, and so they're not. We don't want you. Most people do not want to be filmed, and so at the end we're going to have a question and answer. We'll turn them off, and that will not be part of it. We're going to have this on our website. You'll be able to see this on the website. But yeah, please don't ask anything if you don't want to be on tape, and so do that. Valet's covered, and so at the end, we'll take care of all that. So no worries there. Have a bunch of people from Waverly team here today. A bunch of my old partners, new people. I've really been it's been such a great journey for me the last 18 months working with Waverly and bringing this whole team together. One of my favorite people sitting next to me, my fellow IC member. She's a Chief Equity Strategist and just a good friend. We've really, it's just been great getting to know her for the last year and a half. And so I invited her up here. She brought a couple people. I got Scott and Richard and Chad. And so we just want to put together a panel. We just want to try something different. So we hope you do enjoy it. We're going to talk about macro. We're going to talk about some of the things going on in the world, risk, reward, all the things that you've heard me talk about. Now you're going to hear other people talk about. And so as usual, today we always get together only on days where the S&P 500 makes new highs. So I appreciate that. So we're going to get together next week as well. So appreciate that. I'll let you, Danielle, take over from there.
Thank you, Brad. And it's been a great year getting to know you. It feels like 5 in the very best way. We do it right. Brad actually came down to Charlotte and saw us do one of these panels in Charlotte. And so this is one of the wonderful things about Waverly is the cross-pollination. I am the Chief Equity Officer. I flew in today from Charlotte, as many of you can probably tell from my accent. If you can't, you probably will figure it out by the end. And we have been doing these panels for a long time. I set up the firm so that we would interview different managers as well as pick individual securities. So this was part of our process that we did, and I'm glad that we're able to share it with you. I have been with Waverly for about 1.5 years. They acquired our firm in Charlotte, and I became the Chief Equity Officer. We actually have 5 different strategies now that manage individual equities for clients. So if that's something you're interested in, I head up that group, and I'm happy to talk with anybody at any time, or you can talk to your advisor about that. Kanak is here. She flew up from Charlotte also. She's our trader. We have an individual trader that focuses on the single stocks also. So we really have a good platform in Charlotte, and I'm just so grateful for you guys having us up here to share the portfolio manager experience. When we do interview different portfolio managers for inclusion in the portfolios, we spend a lot of time doing due diligence, and we're really focused on the same things we're focused on from a portfolio construction purpose for the clients, which is, are the managers focused on risk-adjusted performance? So with that, we'll start to talk about that in this panel, as Brad mentioned. I'm going to take some time to introduce all of the panelists, as well as let them introduce themselves, because I can't do justice to their wonderful bios. So we're going to start with the Driehaus guys. We've got 2 people from there. Chad is actually a fellow Tar Heel of mine. So we actually sat beside each other on another panel that unexpectedly brought us together. He actually manages he's the lead portfolio manager for a small cap emerging markets fund that we actually use and have had great success with. And Richard is also with Driehaus, and if he runs out of here like a house on fire, it is because he is expecting his 3rd baby any time now. So we are grateful that he is here. He wasn't necessarily going to be here, so thank you so much. He is actually the head of the entire emerging markets platform at Driehaus. And then we have Scott Becker, who has gone on the Gibson's tour of Chicago to make it here to be with us. And he is at Calamos. He is the Senior Vice President and Product Specialist. And what we're going with, he has a really good perspective on multiple different strategies supporting multiple different portfolio managers. So we're going to weave all of this together into a discussion that focuses on risk, macroeconomic events, portfolio construction, as well as some current events, tariffs, AI, what's happening in the market. So with that, I think I'll turn it over to you guys. Scott, do you want to start?
Sure. So Scott Becker, appreciate the opportunity to be here. I work at Calamos Investments. We're, I don't know how big, small, $40 billion under management. We're in Naperville, just a little bit down the road. We've been in business since the 1970s. John Calamos started us with convertible securities, which if you ask what is a convertible security, is it a bond, is it a stock, is it an option? You could say yes to all of those, right? So it's a bit of an alternative strategy. And it's all about risk-adjusted returns. We manage about $19 billion in liquid alternatives. So we have been heavily focused on risk-adjusted returns throughout our lives. We have a lot of different ways of going about doing that. We can talk about some of those as we talk about some of our macro thoughts, et cetera. Myself, as Danielle mentioned, I'm a portfolio specialist. So what does that mean? I work on the investment teams. I work on the investment committee. I go out and talk about what it is that we're doing, working with portfolio construction, risk attribution. I talk to clients globally. Am I buying and selling the individual securities like these folks are? No. So when performance is good, I walk in and people say congratulations. And when it's bad, I blame portfolio managers. It's a great job. It's perfect. So I've been at Calamos for over 20 years now. Before that, I spent some time at Merrill Lynch, Morgan Stanley, et cetera. So a lot of years in the industry. Really looking forward to an opportunity to share some thoughts on the market and talk with all of you tonight. So thanks for the opportunity.
Chad?
Sweet. Good evening. Chad Cleaver. I'm a portfolio manager at Driehaus. A little bit about our firm. We were founded in the early 1980s by our namesake founder, Richard Thies. It's really focused on a couple of different things. First is really becoming a specialist in growth inflection points. That's what we concentrate on across all of the different strategies at the firm. Today we manage $22 billion in assets across a few different platforms. The emerging markets one, which Richard and I are part of. We have an international developed market platform, and our U.S., which is small, micro, and SMID cap. All under the same common investment philosophy that Richard Driehaus pioneered in the 1970s and served as the basis of the foundation of the firm in the 80s. I'm a member of the emerging markets team. As Danielle said, I'm the lead manager of the emerging markets small cap strategy at the firm. I have been at Driehaus since 2004. I started out as an analyst and became a portfolio manager in 2008. So, very fun time to take the reins of a strategy right before the onset of the global financial crisis. But certainly learned a lot along the way, and it's been an amazing experience throughout my career. Prior to Driehaus, I was at the Federal Reserve Board in the International Finance Division. So I kind of came into the industry with a bit more of a macro perspective. I've spent my entire career in emerging markets, very passionate about the asset class despite its ups and downs, and look forward to being a part of this panel tonight.
Thanks. And my name is Richard Thies. As you've heard, I work with Chad at Driehaus. I am one of the portfolio managers on our emerging markets team, as well as the lead portfolio manager on our global equity strategy, which I think gives us good perspective on sort of comparing relative opportunities of investing here in the US versus companies abroad. I've been at Driehaus since 2011 and a portfolio manager along with Chad since 2014. Prior to joining Driehaus, I was a macroeconomist actually at Northern Trust in Chicago, where I was the kind of head of emerging markets, doing really exciting things like interest rate forecasts and not taking any risk at Northern Trust. And actually before that, I started my postgraduate career here in Oak Brook doing microfinance in Africa and Asia and through an organization that's based here. So haven't been back very often. A lot of traffic, but it's nice to be with you, and hopefully we all learned something.
Scott, I thought we would start with risk. You explained in pretty good detail, just it's the foundation for Calamos. Right now, it appears with credit spreads where they are and the eerily calm VIX, which is the volatility index in the market that has an inverse relationship with the stock market, that risk is expensive. What are your thoughts on, is it appropriate to add risk right now? Is it expensive? Are there pockets where it makes sense? Just some of your thoughts, and maybe at the firm level too, since you talk to so many different managers at Calamos.
Yeah. Risk means a lot of things. There's a lot of ways to define risk. As portfolio managers, we think about it in various terms. It's VIX, it's standard deviation, the way things move. If I'm an investor, if I'm personal or my mom, it's loss of capital, right? It's my spending power. So there's lots of different ways to think about it. So when we think of risk as investing, it's, am I being compensated for the risk that I'm taking? And that's so subjective, right? That's very difficult. It's art as much as it's science, right? And we try to use as much science as we can, but it's art. There's a very famous quote. It gets kind of ascribed to Benjamin Graham, but it's probably really Warren Buffett, that the market is really, it's in the long run, it's a weighing mechanism, but in the short run, it's a voting machine. It's a popularity contest, right? So it moves with sentiment. And so that's what you have to think about is where is it at? Where are we weighing it versus where are we voting today? And you're going to hate this answer, but it depends, right? It depends,
On one hand.
right? Yeah, exactly. And everyone loves a two-handed economist, right? On the one hand. So I think there's parts of the market that are extremely richly valued, right? The Magnificent Seven stocks everyone talks about, they are fantastic companies. They deserve to be expensive. They are producing cash flows hand over fist more than any other company in the world right now. So they deserve to be higher priced. As highly priced as they are, maybe not, right? There's a lot of other names out there in the rest of the world, even the rest of the US, that are not being treated that way. And they are actually really fairly valued. So that's a very difficult question to answer. So the way that we think about risks is where are you talking about? What market? Bonds versus stocks, US, non-US, large caps versus small caps. So that opens up a huge range of possibilities and ways to think about it. So I don't know if I answered the question particularly well, but that is absolutely all we think about every day. It's really, when you're investing, it's really about risks and risk management is what we think about.
And do either one of you have comments on that? Because I've got more specific, international versus U.S. questions for you.
Yeah, I'd weigh in. So, one thing when Danielle put us on the Waverly platform and evaluated us with the due diligence, one thing that she was looking for was just out of favor areas. And emerging markets, small cap was probably pretty high up on that list. And one reason for that, I speak with investors. Sometimes I get this perception of, well, emerging markets is risky and small caps are risky. So emerging market small cap must be doubly risky. And I agree. There's no perfect way to measure growth or to measure risk. But I'll just throw out a couple of kind of basic statistics. If you think about volatility in the market over time, the emerging market small cap index has had about 2/3 the volatility of the U.S. small cap index. So it is less risky in kind of the traditional academic sense of risk. But it's certainly, risk of loss, I think, is probably what we're all worried about when we think about risk. So we have two recent events within the last 5 years where there was a major market drawdown. One of them happened just earlier this year with the tariff implementation in April, and then down with that implementation, I guess, and then a re-implementation. But from that sort of peak to trough drawdown, the U.S. small caps again went down 29%, and emerging market small cap went down 22%. So still, there's an environment where when correlations are high and everything goes down, it tends to go down together. But emerging market small cap again went down less than its U.S. counterparts. And the same was true actually in 2022 during the Russian invasion of Ukraine, where the difference wasn't quite as stark, but EM small cap went down about 29%, and the U.S. small caps went down 33% from peak to trough. So, I think the reason I mentioned some of this is it debunks sort of the kind of common perception around the asset class. And in fact, when we look at risk and how we think about risk as a firm, we're very focused on really trying to truncate negative outcomes within our process. So we incorporate behavioral aspects of the marketplace into our views and in the way we manage portfolios, with the expectation that we would very quickly exit positions if they do not materialize in a way that's commensurate with our expectations. And so, I think that it's this approach to dealing with risk. I like to really kind of spread out the portfolio. We tend to have, upwards of 80 to 100 stocks at any one point in time. So, I think of it sometimes. Things will happen out of the blue that no one could predict with precision. And I liken it a little bit to like a centipede. We're going to lose a leg or two along the way, but we want to keep marching forward. So I think that's it's that DNA and that mindset around mitigating loss is a big part of our approach. Lastly, I would just say emerging markets is a unique asset class in that it's one that's really just kind of cobbled together of 20 to 30 different countries. They don't necessarily have a commonality other than they're developing or they're emerging. And what does that really mean? It means different things in the context of different countries. But what happens is the cycle is very different across a lot of these different countries. And so when you put that together, you get not only an element of diversification of the individual companies and their fundamentals, maybe when one zigs, the other one zags, but the same sort of thing happens with these countries. And so, that's something that, if you ask me the why about that statistic that I led with, about why the asset class tends to be a little bit less volatile, I think it's that diversification element.
And one last question on risk. I'm going to give it to you, Richard. And it's probably going to be the most difficult one now that they already... when we're looking at risk, I think it's a hard thing, like you said, because it can be very subjective. So how do you objectively look at risk? When I'm managing the equity portfolios, I constantly talk about the Sharpe ratio and the standard deviation relative to return. And I showed the chart of this is how much risk you're taking. But what we've seen is a very, very good Sharpe ratio is definitely lagging the NASDAQ and the S&P 500 from a return perspective, right? And when that happens, people are less likely to think the Sharpe ratio is a great tool. So what tools do you use when you're benchmarking yourselves to stick with this, our risk-adjusted return? We won't want to take too much risk. We want to take the appropriate amount.
I think for us, this is probably a different answer than you get for most people. Most people would say like buying an expensive stock is very risky. I think our view, if I can speak for you, would be that not buying an expensive stock is a very risky thing if you think the company is going to remain expensive and is going to continue to do really well, which has been the case in the US for 14 years. So taking a very simple approach of saying, this thing is expensive, it's already done well, ergo it's bad, is a pretty risky way to go about things. What we try and do is think about where expectations are, and specifically what the second derivative, what the next information is going to look like. So similarly for us, it's not enough that you're looking at companies that are cheap, because cheap companies are usually cheap for a reason, because they're not doing well. And for us, there are different approaches, but for us, that's not a reason for us to invest. We would invest there and love that if we felt like the incremental information was going to get better. So I think probably the question on like your mind and everyone's mind is about the US and mega cap leadership and stuff like that. And I've actually been like fairly positive on that space, just because kind of the reasons that Scott mentioned, that's where all the cash flow generation has been. That's where the earnings power has been. The question is really, what does it look like when you go forward a couple of years? And that's where I think you're talking about risk. Like even to me, I don't find companies like Meta, for example, to be wildly expensive for what you're getting. The question is, do you want to be buying companies that are spending 30% of their revenue on CapEx when you don't know if that's going to be good investment or bad investment? So really, and this is not a helpful answer, but it comes down for us to what this company specifically are doing, and what you think the information is going to look like, because the actual businesses for these big companies are not going to change that much. What's going to change a lot is how people view it and how people view the outcomes. That's why, like, is Tesla that different a company today than it was 5 years ago? No, but we have more information now, not even talking about politics, but we have more information now about what the EV industry looks like. Everyone knew that margins were going to be low. Now people care about that. They didn't care 5 years ago. The same thing is likely going to be true about AI and CapEx 5 years from now. It's not true now because we're all excited about it. So we think about it in stock-specific terms.
Yeah, and I think I'm just going to add on to that, which is not a script, so apologies. But I've been covering software for 30 years, and the amount of CapEx that these software companies are spending should have some implication negative to the really high multiple they have for having very high margins and free cash flow, because it affects the free cash flow. But the multiple's just gotten larger. So, but when does that happen? Like you said, there's the near-term voting that is very complementary to that.
I was only just going to add, to your point, Sharpe ratio is it's a great ratio. So Sharpe ratio is basically how much return do you get for how volatile are you, right? So that's a good measure. There's another one that says it's called the Sortino ratio. How much return do you get for your downside volatility? Because the theory is, I'm sure you guys don't call up and you say, hey, I'm getting too much upside volatility, right? No one ever, hey, I'm getting tired of this, right? Like, no, keep that going. Just don't give me this, right? So risk-adjusted returns are very important, but you need to be aware of that. Like, there's the old saying, like, you can't buy a risk-adjusted hamburger, right? You need returns. So if you've coached very well, which I hope you guys have, that is important, right? You need to get to the right place, but it's the ride that matters. And the people who don't understand that get out at the wrong times and never get back in at the right times. And those are the people, there's thousands of studies that have shown that the stock market gives you an average return of, let's just say it's 10%, right? Some say it's 12, some say it's 8, 9. But the average investor never gets that because they say, oh, the world's ending and I'm going to get out. Then it recovers and they go, oh, maybe I should get back in. But they already missed the fun part and they get in too late. So these are all very important statistics, and it's important that you have an advisor who understands these and looks at these things. So it's quite important to think about those types of measures. Yeah.
And when you're looking at the international space and what you're talking about, the natural diversification by geography and the kind of in one geography, something's happening here versus the other. What are some of the risk factors that you look at, such as geopolitical, when you're putting the portfolios together that maybe domestic portfolio managers don't have to consider as much?
Yeah, I think that was one of the attributes that really drew me to emerging markets, quite frankly. So I was in college in the late 1990s with the Asian crisis was going on, and this was sort of this live teachable moment where we're blending kind of the economic theory that we're learning in the classroom with something we're reading about in the Wall Street Journal every day. And what particularly captivated me is it's really more like a game of chess. You have to consider not just an individual company or even kind of country fundamentals, but also the interplay between politics and macro and markets and currency. And it's a fascinating landscape. And it's tough to predict a lot of these things. And we will always have views, but we also recognize that due to the inherent kind of inability to really understand which way the world is going to twist and turn next, that we don't want to necessarily make a big sweeping view and implement it in the portfolio. And I'll give you a kind of live example as to why. If you had asked me on April 2nd, what are 2 emerging market countries that are going to be relatively immune from the tariffs, I would have probably said, and I think many emerging market managers would have said, India and Brazil. They're relatively closed economies, low proportion of trade to GDP. In India's case, Prime Minister Modi seemed to have a pretty good relationship with President Trump. And I think if we're reading the news these days, we know that is definitively proven not to be the case. Brazil is the one country which, despite having a current account surplus or a deficit with the U.S., has been hit with tariffs mainly for political reasons. Conversely, India, there's a lot of candidly, what I think is just more a negotiating ploy and a lot of very heightened rhetoric going on right now surrounding the inability to get a deal and sort of pointing fingers at India's importation of Russian crude oil. but this, suffice to say, has not played out how I would have predicted, and I think most emerging market managers would have predicted. So I think that's a sort of example as to why we don't want to, number one, undertake these kind of short-term knee-jerk reactions, and number two, really steer large amounts of capital based on something that's really inherently difficult to predict.
And you mentioned that you look at, specifically for the company, the second derivative, which I'm a big believer in. Also, how do you look at the second derivative for the geopolitical risk, right? Which is, you have this one thesis, like, how do you track that? It's not numeric, it's intensity of negative headlines or risk. Like, how do you guys think about that or manage that?
Yeah, I think we kind of follow the news like everyone. I think we were actually quite positive in April about the fact that, say what you want about all the tariff headlines and everything that happened, but it seemed when China got to 135% tariff, you were like, this is probably as bad as it's going to get. So we do look at it in a second derivative level, and I think the biggest thing for us, just looking at risk and opportunities of investing abroad, really starts with FX and currency, which is something that, is kind of obvious. Like if you're putting money in a different country and you trust that the company you're investing in is going to generate free cash flow and generate earnings, like it's pretty important to you what the value of that is when it comes back, if you're investing in a place where the currency is weakening. And this has been a massive headwind to international returns for the last 14 years. So if I can take 1 second to be really boring.
It's one of my next questions,
okay,
so you run with it.
Okay, so the US dollar. Oh, no, I'm kidding. But actually, I'm sort of serious. The US dollar is the most important currency in the world. It's by far the majority that most people trade with abroad. The US dollar, currencies are confusing to a lot of people, myself included sometimes. But it's really, the value of a currency is driven by supply and demand. So just like anything else, if there's more people who want it and there's not enough supply, the value goes up. When that has been broadly the case for the US dollar since 2011. And starting points really matter. So if anyone in the room went on a vacation abroad in 2011, things would have been very expensive for you. So if you went to Brazil, Rio de Janeiro in 2011 was the most expensive city in the world, not because it's a really developed place, but because the currency was so overvalued. So if you're putting money into Brazil at that time, you're probably going to lose money. And in fact, that's what happened. And the US currency tends to go in sort of 10 to 15 year cycles where we've been appreciating, capital has been flowing here for the last 10 years, 15 years. That is starting to stop a little bit. And with that, the US currency is starting to weaken. If your currency is overvalued, a few things happen. One, you spend too much money, which check that box. And you set the stage for the currency weakening in the future, which is, in our view, that's what's happening. So the risk and the biggest filter by far is knowing your starting point of what kind of FX risk you're taking abroad. Because if we trust that equity returns are kind of similar, 10% in India, just as they are here, if you're also getting money from currency appreciating, you can actually make a lot of money. And that's why emerging markets since September are outperforming the US. It's not because the companies have made way more money than American companies. It's because, Real was 6.5 in December and now it's 5. You've already made 20%. So that's the kind of big trend and the big picture that I think you have to keep in mind when you think about risk of investing internationally. And our view is that we're kind of in the very early stages of that being a positive factor.
And that's a good parlay into the macro and interest rates, but I'm going to go a little bit deeper on that, which is if you look at emerging markets, and I don't want to minimize what you do at all when I say this, but the correlation of how emerging markets funds and stocks behave is a directly inverse relationship with the US dollar. So you could have one of the best companies in emerging markets, and if the dollar is strengthening, you're going to see this negative return that you really can't dig yourself out of. So I think that's been the frustrating thing for domestic portfolio managers and clients is, why do I own this? And you really couldn't fight it because the dollar's going up. But you made a really good point last time we talked, Chad, which is the last time we had this cycle of a weakening dollar, now I'm going to hand it to you, what happened? And if you could set the stage for everybody, to that time period and how long that lasted.
Absolutely, and Rich is right. These tend to be really long cycles. Just on average, going back to the 1980s, the average duration of a dollar sort of appreciation or depreciation phase has been about 9 years, and the magnitude has been on the order of 20%. To put it in perspective, where we are today, it's a little bit more of like a coiled spring. That's 15 years of duration and 42% of appreciation since 2011. But looking back at the previous cycle, and I'll just put some numbers behind it. Say you bought the market on the day that the U.S. .com bubble peaked in August of 2000. It would have taken you 11 years. It would have been 11 years until you had definitively broken even. You would have had a nice little moment in the back in the green and right before the global financial crisis, and then gone right back down. So over that 11 years, though, emerging market equities generated 10% per year. So think about that, compounded over a 11-year period. And that was the last time that we saw one of these really pronounced phases of dollar weakness. And certainly, I'm not here kind of arguing that history is going to exactly repeat, but that there certainly may be some areas in which it rhymes. And I think probably the most important point, as Richard alluded to starting points, is this is a very extreme sort of level of starting point that we're experiencing right now.
Yeah. The last time the dollar was this overvalued was at the .com crash.
Mm-hmm. And the same with technology as a percentage of the S&P 500. It's very similar. That was my first job. I was at a Weisel in San Francisco during the .com bubble. So maybe I'm just a little skittish and just waiting for it to drop. But I will say, when I started my individual RIA business that I sold to Waverly, I had one of my first clients came to me from, I won't say who, but he had 80% in emerging markets in 2009. And I was like, that's too much. And he said, but they're growing. It's great.
I don't think they would think that. I think 80% is not the way you're looking for now.
It was. I mean, it was because that's what had done well. Right. And that's what was doing well. So the point I'm trying to make with that is that you should always have some of what's not doing well, because there are all these different factors that shift, often unanticipated, like India, And so I'm going to switch back to you, Scott, because I think the interest rate situation, as much as people think interest rates are not exciting, they really are dictating everything that happens from a macro perspective as well as domestically here in the U.S. And given your focus on alternatives, which everything's interest rate sensitive across that platform, what's your firm's view on interest rates, specifically the U.S. pricing in, a pretty decent rate cut trajectory going forward with inflation still high and the stock market reaching new highs?
Yeah. Just like most things, it kind of depends on which way you're looking at it. Inflation is certainly high, but it's also not 9%, which it was not all that long ago. So we're above 2, but we're not 9. The Fed funds rate is still above the 10-year, which that's weird, right? So that's an inverted curve. You should have higher rates at the long end than the short end. The Fed only controls the short side. The market controls the long side. So where should it be? All things considered, money should cost something, right? We just came out of an episode where the Fed took rates to nothing. And while that feels really good, like if something's free, it feels great, right? I want more free. People make horrible decisions when things are free. And that's usually what leads to things blowing up and market crashes and over, spending on things. So that's a dangerous place to be. So where should we be? Like, all things considered, the real borrowing costs, right? So the cost of borrowing minus inflation is really not that high. So you could make a very strong argument that rates are right where they should be. Maybe 2% over the cost of inflation. The real cost of borrowing is not that high. Could you lower them? Sure. So we think they probably will. The market is kind of pricing that in. The 2-year rate kind of is a good predictor of where the Fed funds rate should be. So we think it probably will. And I think the market can handle it. So we think that that's where it will go. To us, we like it when the Fed gets out of the way, right? Let the market decide where things should go and let the market kind of figure out, because ultimately that's all investing really is, right? If a company is borrowing money, are they making a return on that that's higher than what they borrow at? And if they are, bravo, right? And they keep going. And if they're not, they go out of business or someone acquires them and fixes them and they get back, right? And that was kind of the problem that Japan had for decades, is they had these zombie companies that ran around, and they're still trying to right the ship in many ways there. And that was kind of the concern that we had in the U.S. is we brought rates to zero and we didn't let businesses fail. So it's a tricky situation. Now, where with rates, kind of where they are, it kind of makes it's difficult to be a bond owner, right, when you're not getting any return on your bonds, right? So we're glad to see rates have something. There should be some return if I'm a bond owner, right? And if I'm, getting older, which I am, right? I want some safe investments. I want some risky investments, and I want some safe investments.
You sure you don't want 80% in emerging markets?
I did in 2009. I wish I had known. So we do think they'll probably kind of cut. I mean, clearly that's we can see politically that's what Trump wants. I mean, he wants to reduce the borrowing cost of the U.S. He's pressuring that on a relative basis relative to the rest of the world. We are higher on a relative basis, but it's still really not that high. But we think they will lower it, but that's not going to probably change where the 10-year bond is or the 30-year. It's not going to change that. The market controls that side of the equation. It's the Fed only controls one number. If they cut that rate tomorrow, they're not going to do it tomorrow necessarily, but the next round, I don't think that changes where kind of the rest of the market goes. But that's positive for equities. That's positive for small caps, right? Because everyone says, oh, small caps, those companies need to borrow a lot more than a large company does. So small caps got stung in 2021, 2022, and not all of those companies deserved it. Some of them did, but everyone paints with a broad brush. The market tends to overreact massively in the short run, and then they correct themselves. So there's some deals in the small cap world. I mean, there's some really great businesses out there that got crushed, and there's some great companies that are recovering. Small caps are already rallying a little bit. They rallied really rallied the day that, Powell said, hey, I'm thinking about changing my tune. They had like 300 basis points, 3% outperformed large caps. I mean, so there's some real good room there. So I think it could be a nice positive.
I just don't want to keep getting head faked by that small cap rally.
Yeah, that's true. That's a good point.
I wanted to weigh in on rates from an emerging markets perspective, because this is the first time, as I've been in the market 20 years, I'd say this cycle coming out of the pandemic is unique to others that I've seen, in that emerging markets, in particular on the central banks, have been ahead of the curve this time, where they've been sort of notorious for being behind the curve. And what do I mean by that? And I even kind of take it back to the pandemic itself, where we all experienced the same sort of things, the lockdowns, the economy is grinding to a halt. But one thing that emerging markets by and large did not do that the U.S. and Europe and other developed economies did was engage in the same degree of both fiscal and monetary largesse. Largely, they implemented crisis time policy, and then when the crisis dissipated, they moved very quickly to normalize that policy back to an appropriate level. Whereas if you remember in 2021, what was the common refrain coming from the Fed? Don't worry, this is all just going to be transitory. And lo and behold, 2022 was a very sharp interest rate hiking cycle in the U.S., whereas many of the emerging markets were kind of already there. And why is that important? Today, we're kind of seeing the ramifications of that. First of all, the debt levels are not nearly as bad as they've been in the past, as these economies have continued to grow, and they didn't pile on extreme amounts of debt during the crisis. Number two, they're now in some cases in areas where they can cut interest rates. We've seen quite a bit of that activity across a number of emerging markets right now. And number three, from the inflation perspective, it would probably surprise some in the room to know that inflation in India is actually lower than it is here in the U.S., so about 1.6%. And so, inflation has really been at bay in many of these markets. Some are cutting rates already, and some, like Brazil, have enormous amounts of dry powder to be able to cut interest rates, where rates today are on the order of 15%, and inflation is roughly 5%. So I think that's maybe an underappreciated aspect of emerging markets just in the relatively recent future or recent past.
I think we've done a really good job of looking at the fundamentals of investing and portfolio construction as well as the macroeconomic. But I think we probably need to move to some more current events, which is what people are really, the most recent history is tariffs. And I know everybody's sick of talking about that, but I'm going to put a little bit of a spin on it, which is, when we were talking about tariffs, people were terrified. And no pun intended. That feels. And I've got a bunch of them: tariff tantrum, tariff ping pong. I mean, I got a whole arsenal because it's all we talked about for a long time. And people got very scared. And people were, everybody, all the economists were talking about how bad tariffs are for the economy, which we all fundamentally know. But you saw the quickest recovery in a market in history from the bottom of the tariff tantrum, if you will, to where we are right now, hitting all-time highs. It goes to 2 points, which is, one, you can get scared of tariffs. If you got out of the market, you didn't have time to get back in. No one did. It was very, very quick. And given that we rallied to all-time highs right now, I mean, are we not pricing in any risk of tariffs? What are your thoughts about the reality of the tariff situation right now? And is the market pricing in those concerns? Because we've already superseded where we were before this whole thing started. Scott?
All right. I think the market massively overreacted to the tariffs. And they said there's much more uncertainty, which is true. But more uncertainty doesn't mean the certainty of a recession. And that's what they priced in. And then they said, oh, wait a minute, that's not necessarily the case. Now, hear me out. Tariffs are a bad thing. And everyone has to say that because the tariffs are a tax and tariffs are putting artificial barriers and artificial pricing in, which is a bad thing. And they're all saying, hey, these tariffs are back to where we were in the 1910s and the 1920s. Yeah. Our economy today doesn't look anything like our economy in the 1910s to 1920s when we were a manufacturing economy. We are a service-based economy today. Like 85% of our economy today is service-based, right? It's an information service-based economy. So it's a very different. The other thing is, the Trump administration is saying, look, we need to raise some revenues. And we have two ways to do it. One is we could raise taxes. Two is we could raise taxes through a tariff, and I'm going to try to trick you into saying I'm going to make them pay for it. They're not paying for it. We're paying for it, but I'm going to make you think they're paying for it. Okay, cool. Now, that said, here's the difference. If they raise our taxes, right? Let's say I make $1,000 a month and I take home $700. They raise my taxes. Now I take home $600. That stinks, right? Let's say they raise the tariff on Japan. All right, guess whose kid's not going to get a Sony PlayStation for Christmas? My kid, right? They're going to get something from Mexico. They're going to get something from Europe, right? There's a substitution effect. I could buy them an American product. And again, that's what I think the Trump administration was trying to do. Let's get something built or made in the U.S., which, by the way, that's a taxable exchange for consumption in the U.S., and then that company pays taxes to the U.S. So again, that raises something there. So I think that was the goal. That was the end game. Probably wasn't presented particularly well. And I think that's why the market overreacted, then kind of snapped back. So I think that was part of it. Now, there's legal ramifications, and it's probably going to end up going to the Supreme Court, and who knows whether they're going to have to pay this all back. Can they? It's probably going to go to a long legal battle. Does he have the right to do all this? It's probably going to continue to get pretty ugly. But I think that's why the market did all that. Why is the market at all-time highs? We have more earnings in the S&P 500 today, more earnings expectations today than we had before Liberation Day. So I think there's some logic to it. So I think cooler heads prevailed ultimately. I That's what we do as a market. We overreact. And again, that's kind of our job as investors to say, well, what is the market pricing in? Are they pricing in doom and gloom? Okay, well, maybe I'd want to add on some more risk. Or are they pricing in, hey, we're all going to do this forever and ever? Well, that's not true either. I should be taking some risk off. Like, that's how you have to try to think about the market.
You know, it's to be risky on Christmas Day when you give your son the U.S. made equivalent of the Sony.
It's a very good point.
I want to see a video of that.
I should be in the other room.
I might be more scared of that than a tariff. That's right.
Can I add a couple things on that? So first of all, I think, I agree, obviously, that we overreact, and that's the whole business. But part of the reason that the drawdown got so bad in stocks was because it seemed like the bond market was also not functioning. We're used to stocks going down, and at least we make money in the bonds. And it was so bad that it seemed like people were selling bonds, foreigners specifically. So that, I think, just added a lot of fuel to the panic, which arguably is why a lot of the stuff got drawn back. On the impact of the tariffs, I think there's two things to consider. One, which is kind of what you were alluding to, Scott, is that most of the people and businesses that are affected by tariffs don't trade very much on the S&P 500, so it doesn't really matter. And it's so downstream to those companies, like what Meta spends money on, that it's really not super important. The sort of third point is that if we were going to see it, you wouldn't have seen it yet. I'm not going to name any of these people by name, but if you look at the data for how much revenue the U.S. has collected through the tariffs, you would see that it was basically zero until like the last 6 weeks, which tells you that none of your prices went up. Why did that happen? One, companies front ran it, so they imported a lot ahead of time. The second thing is there's about 15 people who work for the Border Patrol, and now all of a sudden they have to process tariffs on everything that comes in the country. Guess what happens? Nobody pays tariffs. And like the biggest, I can't say it, but very large companies do fake invoicing and don't pay tariffs. So like you didn't see anything for a long time. Now that's catching up. You see it in the data. And actually a data series that I find very interesting is the tariff collected, because it tells you what is actually the negative impact, and it's only showed up in the last month. So really, tariffs haven't really existed yet. So we'll see.
So again, to go back to your second derivative, if we're just now starting to see them, that should accelerate, and that should put pressure on earnings.
I think incrementally, but I think the biggest point for like broad equity exposure is that the companies that have been guiding and talking about tariffs are like small consumer companies. It's not Meta. It's not, Microsoft. So.
Right. Because their bill of materials is nothing that you put a tariff on. And that's a good segue into the other popular current event, which is AI. And I'm going to kind of spin it a little bit differently and say, if you're looking at, we know that we're in the massive CapEx cycle that's driven the semiconductor index to an all-time high, as well as a percentage of the S&P 500 higher than it was for the last 30 years, if I go back and look. This semiconductor cycle is different because, as we've all noted, the free cash flow is enormous, and it's different because it's fabulous, and we're using Taiwan for a number of reasons. But if we start to look at our service economy and what's being replaced with AI, like I can download like literally my first job by pushing a button. I'm like, that's what I did my whole first year out of college, and it's completely gone. So what do you guys think the ramifications of AI longer term for our workforce are? And that's a big one, I know. So I'm just going to let you fight over who gets to go first.
Well, and also, how are you using it? I think one of the things, especially for our business, it's starting to come around, and I think it's been impactful on research. But how are you guys using it in your business? And also, obviously, how do you think it's going to be impactful for markets and productivity and things like that? But how are you using it in yours? Because I think everybody here has businesses, and they kind of trying to figure out how to use it and how to use it in the best way. So how are you guys using it in your business?
I'm happy to start. So I think in the investment management business, artificial intelligence is like a very useful tool because it is essentially a knowledge-based business. And what AI does is obviously some processes, but also does a great job of finding you information and collaborating information and making things more useful. So the fact that, a lot of like what you would maybe ask an intern or a junior analyst to do, like look at this company, like you can have ChatGPT do that in 5 minutes and it's probably better. I think it would be very naive to think that doesn't affect the workforce. And this is obviously like a huge subject that nobody really knows about, but I think there's a reason that throughout human history, people have panicked every time there's been a technological innovation, and we still have jobs because you're freed up and you find something else to do. The population does. Now, has there ever been something that creates a technological innovation that creates human intelligence before? No, there hasn't. So I think it is fair to wonder about it. And my biggest view that I think is most of you probably will think is insane is that if you're talking about the types of jobs that it will replace, it's software developers, it's people like us, it's high-skilled, as you said, service sector wages, more so than it is like labor, traditional labor. This actually relates to the currencies conversation. So a software developer in the United States on average makes $200,000 a year. A software developer in Paris makes, Chad? $60,000 a year. So if both of those jobs get replaced, who gets hurt the most? It's not Paris, it's the US. And we paradoxically have the companies who are gonna, for now, generate most of the cash flow from the innovation, but we're also gonna, if you believe that there is job loss, it's gonna be acute in the US relative to the rest of the world, just because we're further ahead. Sorry for the darkness.
So I wanted you to say that, not me.
Yeah, I would agree that it's definitely an amazing data aggregator, and it's fast. It's not an idea generator. So, like from a creativity standpoint, someone still needs to be the instructor of that. At least now, who knows? As it's learning, I don't know where that's going to go. So that's very interesting. But as of right now, there's still like the hallucinations, and there's definitely things that I've been testing with it where I'm like, no, that's wrong. And I've looked at it and that's not accurate, right? But there are some things where I'm like, that's amazing. It would have taken me a week to get that together, and that took it all of 3 minutes. Right. So
I find it's good at aggregating, but not synthesizing or critical thinking yet.
Yeah.
Which may happen, but when I sit down to look at a stock, I would go to 6 different places to get data. Now I push one button and it goes to all those places. And that's why I said that was my job for a year, was to do that. And it's done. It's great. Right. So I don't know what people coming out of college are going to do because they don't critical think yet. So
there's a reason why unemployment rate for college kids is the highest since 1982.
Yep.
I think there's no doubt.
Yeah.
It's really part of it.
Well, I'm going to let you open it up for questions.
Well, because I don't know if you want to stop the recording. We can open it up for questions. Definitely thanks for this. This was incredible. Appreciate insightful round. So it was really great. So really do appreciate that. And so we're going to open it up for questions. We don't know, like I said, we don't normally let people ask questions. We usually have people write it down. But we have a really civil audience here today, so we're going to just open it up. And I don't know if there's a microphone around somewhere.
And I'm from the South, and we just love questions.
Yeah. So I don't know, Chris, you got a question? Yeah.
The concerns, just more broadly, whilst everything we're talking about is a lot of sources of information, individuals, agencies. The current administration seems to put pressure on those chronicle information comes that doesn't necessarily agree with or support the agenda.
Sure.
You all make sure things know you're getting good information, you're getting facts, getting the raw data or the appropriate way to process the data that you're looking for.
Chad and I have been covering China for 20 years, so we're really used to this.
I'm used to zero.
I think ultimately you end up seeing, from our perspective, you end up seeing it. And I was trying to be funny, but it is true that this is a common thing that happens around the world, that leaders don't like data, so they change it. And I will say that there's very justifiable reasons why you would be upset with the BLS and the way they conduct data, taking politics out of it. Like, how crazy is it that we're talking about AI and everything you can do and they don't know how many jobs were made? Like, there's obviously a better way to do it. But I think what we do is validate trends really through company specific stuff. Like, if China tells you that online sales are growing 10% and Alibaba's GMV growth was 4% and they're the biggest player, you're like, that's obviously wrong. So kind of look for secondary sources.
Yeah, I think kind of cross-check it against different information. And we have, all of the regional Fed banks do different types of surveys. So you can maybe see activity levels picking up here that tend to be a leading indicator, say, of employment. So you can maybe say, okay, to go back to my transitory analogy, but maybe this little soft patch we've had in the jobs data is going to prove to be transitory based on some of the other things that we can see picking up. And then maybe also, I like to say this kind of ties into the AI discussion a little bit. I think, for me, one of the overarching conclusions around AI is just commoditized information is going to be, that if you sort of traffic in that's going to be a tough future for you. But, custom data sets or ways to sort of get, on the ground data that maybe AI can't replicate. There are many hedge funds that do that and they trade on it. And so you can see maybe certain stocks acting in a certain manner that may sort of corroborate or sort of dispel conclusions that you might draw from some of the dubious data that's collected and disseminated.
And I'll say what I do is I spend a lot of time going back old school. I'll actually listen instead of reading the transcripts. I'll listen to the earnings calls. So what the management team's saying, the inflections in their voice when they answer questions. I think that's lost in just reading the data. So there's certain work and experience that you can provide when you're looking at individual stocks, but it's much more difficult to navigate what's real and what's not. And you really have to kind of
there's a lot of great
come up with some alternative ways.
Yeah, some real-time sources. That's when I ran hedge funds, you had satellite images of malls. You had Citibank has some really good data. There's certain ones that they're incentivized to have good data. And I think they're out there. You do have to go find them. A lot of them are expensive.
They're real expensive.
To get. And so, but there is no doubt, it is really difficult. I just remember I've traded off of the Friday jobs report for 35 years. And last year, when they basically cut 6 million jobs, I think I stayed in bed all weekend thinking, what I've been doing for the last 35 years. I've been using this data, and it hasn't been real. So it really was a kind of a punch in the gut a little bit. I do last year when they did, make that adjustment, and it has given me a little bit of pause on. I think even the volatility on Fridays around that, it just hasn't quite been there. I think the credibility on it has gone down a little bit.
Okay. Here's one nobody's talking about. That indication. I mean, there's always been some political overhang.
Sure.
Edges. Is it different this time? And are you guys concerned?
So Rich and I have been managing emerging markets.
Nothing's as bad as China.
China, though.
Or Turkey. Or Turkey, right?
Yeah. So the question, I think it was hold up a sign and say, look, repeat the question. Fed independence, is it different this time and are we worried about it? There's an old expression that the most dangerous words in investing is it's different this time. So it probably isn't. It's probably more vocal. It's probably more apparent. The Fed is meant to be independent. We're all humans. So we all have our angles and our sides and our opinions. So I don't know. I would argue, though, that this administration is much more vocal about their belief. So yes, of course, we're concerned. I think you have to be. You're hopeful that cooler heads prevail. But I think you just kind of have to read through it. And ultimately, wherever that rate goes, that is a barometer of the cost of capital and therefore good businesses, bad businesses, et cetera, right? But if that rate goes to some absurd level, then yes, bad decisions get made. That would be a dangerous level, right? So does 25 basis points really matter too much? Probably not.
Do you think maybe the long end stays maybe a little stickier higher because people are like, maybe that inflation, somebody comes in, they're going to cut 100 basis points because that's really what, I mean, do you think maybe that long end, and one of the questions I was going to ask before about mortgages, I think there's this misnomer, and I think you see it in the news that, oh, good, they're going to cut rates by 100 basis points. My mortgage is going to go down by X. Yeah.
Right.
I mean, it's just not true. Right. I mean, and so I think that's one of the biggest things I'm seeing in the news that is actually flat out wrong and probably is not going to happen is all of a sudden, that long end. And I think the whole Fed independence and just this, markets price it, right? Buying and selling and supply demand, just like we were talking about. So I think that potentially could be a ramification of kind of that fear around it, at least short term. We'll see, over the longer term.
Yeah, that's the thing. It's like ultimately counterproductive. I think it always has been political, but if you really wanted mortgage rates to be lower, you'd let Powell be hawkish and let the curve flatten because it does affect it. And that's the thing. It's like there's no getting away from the price of money. So if you do all these things and the yield curve steepens a ton, like that's how it's going to be. And if the Fed remains credible a year from now and the yield curve goes back to flattening, then it's everybody's choice, as you're saying. So,
Okay.
What do you think is baked into the interest rates and into the 5 minutes at this point?
The question was, what do you think is baked into the market and interest rates at this point? As far as a cut?
25?
There's 5 cuts priced in by 1 year from now.
So should I be for September?
For September, it's like 90% of one.
Yeah.
Yeah. They went 50 for a brief moment, or kind of started going, but I think it's kind of all been pulled back, especially with some of the inflation news, some of the jobs. I think it's all been pulled back for the most part to 25 in September, 25 in December. And then, like he was saying, probably another 2 to 3 next year is kind of what's baked in right now based upon the futures curves and, looking out. So.
Sounds aggressive to me. I want to go back to the tariffs just because it seems to me with all this vacillating and stuff that absorbing up front, the front ordering all this, that it hasn't hit us yet. What is your view of the longevity of this process or whatever we expect? Because it seems to me it just hasn't hit yet. Well, is inflation going to continue to grow and that just reduction of the prime rate is maybe not a good thing? That's just, so what are your thoughts on it?
The question is, if we start to see the tariffs trickle in and prices go up, and then we have inflation at the same time, we're reducing rates, what are the implications of that?
Yeah, I mean, my personal view on that is that the next couple months, inflation is very likely going to be higher, noticeably higher, which makes the pricing in, I think, more than 5 cuts in a year kind of a high bar outside of seeing very weak economic data, which it doesn't seem like we're going to see right now. I have it's funny because you can go to a lot of school and talk to a lot of smart people and no one knows where interest rates are going to be or where inflation is going to be. My personal view on the way the US economy has functioned the last 20 years is that you don't really get big sustained inflation issues outside of strong demand. So do you see spikes in inflation because of tariffs? Yes, I think it will very likely be transitory because demand is not strong enough to sustain sustained and rolling price pressures. That's my view.
Yeah, and the other side of the inflation argument classically would be money supply, right? If we're throwing a lot of money out, that's inflationary, and money growth really hasn't been. It's been slow, so you could get like a lift, but it wouldn't be like a secular demand for that. We also have agreements with Mexico and Canada on other goods that are hopefully helping on certain products, more like food that hopefully is helping certain things that we need more than we want. So there's, I suppose some hope.
I hate to see this whiplash thing.
Yes, of course.
Maybe I'll just throw a middle ground perspective just for food for thought. I think it's just highly ambiguous, to say so one of the experiences that kind of colored my whole career was when I was at the Fed, right out of college, 2000 through 2002. And there is this, what I just call like a ceteris paribus world, where the Fed has these models and they say, okay, we're going to shock one variable, and this is how the rest of the economy is going to play out. All else equal, we do one thing, and then this has this set of impacts. And it's just not it's not a ceteris paribus world. It's a world it's characterized by ambiguity and uncertainty. And the ambiguity that I see here is, for every good that there's a tariff ascribed to, there's an exporter, there's an importer, and there's a consumer. And so you have to really evaluate, I think, in a more nuanced way, things like the price elasticities of demand and the relative bargaining power. So, I think in the, Danielle alluded to the conference calls, from the sampling of calls that I looked through in U.S. earnings, I would say, rough estimate, certainly the majority of the companies were opting to absorb the tariffs as a margin hit to themselves versus trying to pass them on to their consumers in this environment. It certainly doesn't mean that that's going to be the case for every good. And as Rich said, there certainly could be some inflation. And I think maybe connecting a few of these dots, what if the labor market isn't so bad? What if inflation is really starting to pick up and the curve has 5 cuts priced in, and we have someone who might just throw an absolute tantrum if he doesn't get his cuts? That's maybe a risk that's not being as discounted today.
That's reality versus expectation, and that's where fun comes, right?
Yeah.
And that's where
So I think we have time for one more question.
Just curious your guys' views on crypto. It seems to be, becoming more of a factor. It's government's view of it. Start reading about companies making investments into crypto, and it's kind of like, it just seems like a new dynamic in the overall scheme of investing versus more speculation. It's not supported.
I'm happy to take this.
We can ask about crypto.
Yeah, sorry.
What's going to play out? And no, I think it's super fascinating on crypto and what's going on. So
Yeah, I have been an early advocate of crypto, and the only thesis has just been that there's no bottom to U.S. money supply, and there's no controlling the U.S. deficit, and it's as simple as that. Do I buy companies that leverage their balance sheet and buy crypto? Absolutely not. That's no, we don't have that in the portfolio.
how about convertible?
But I think from an investing standpoint and kind of just like how the world could look, and this is like not a high probability short-term outcome, but the development of the stablecoin industry, which is basically, like, for those who don't know, is essentially, instead of having a money market fund, you'd buy a US dollar coin, crypto coin, that would have the same type of yield as a money market product and have the very appealing property that you could buy it if you don't live in the US. So if you think that somebody in China wants to get money out of China, they could buy a US dollar coin, and that's effectively cycling money into the US, which would be great for the US if that actually happens. I think the development of those coins is also very impactful for e-commerce and the payments landscape. I think, I wouldn't short these companies necessarily because they have such big barriers to entry, but companies like Visa, MasterCard, and Amex have been gouging everyone for years, and they provide a very limited service. They do it well, but if you can buy a coin and then just transfer it to Amazon, Amazon can save 150 basis points in their margin. They're going to do that. That will happen at some point. That's my core view. Whether it happens today or not, I don't know. There's also a very direct link over the medium term between cryptocurrency and AI, which is that AI can spend your cryptocurrency, your stable coins, in a way that, if you believe in agentic commerce, my AI agent 5 years from now knows that I need new glasses and buys them for me, and I don't have to participate in any of that transaction. That will all be done on crypto, not on your credit card. So it's a very exciting space. The craziest thing to me, conceptually, is that the U.S. government would be supporting it because it is subjugating the dollar, which is arguably truly our biggest asset besides the military. But other interests happen. I think ultimately it's probably good. It fosters innovation, and it fosters a lot of that creativity and investment happening in the U.S. rather than happening in China or India. So in that standpoint, I think it's a positive.
Yeah, I think two things. One is there are companies that issue convertible securities, MicroStrategy, where essentially Michael Saylor is saying, I'll buy crypto, you buy my company. And that makes no sense to me. Like, why should I pay you to buy?
How big is that of the convertible market? It's actually become a sizable piece because there's a bunch of companies doing it.
Yeah,
right?
there's a lot of companies that do it. His is probably like 5-6% of the convertible market. I don't get it. We don't understand it. Like, why should I pay you to buy Bitcoin? I can buy it. Like why am I paying you? So, but anyway, yeah.
Because he can take more leverage than you.
Yeah, exactly.
And he's Michael Saylor, and he did this during the .com bubble
Yes,
too.
exactly.
I was there for that.
So it does feel.
It was the same name, different company.
This is not being recorded, right? That does feel a bit. It feels a bit like a grift to me. But I do believe in Bitcoin. The technology, the blockchain technology, and in the encoding and the limited 21 million coins and the security. It's the most secure, the most decentralized. The problem with Bitcoin is it's slow relative to the other coins. The beauty is it's the most secure and the most decentralized. And if I'm dealing with my money, I'll take slow if I get safe. Now, in the US, we're probably a little less concerned about that than if I lived in, say, Latin America or maybe parts of Eastern Europe or Russia, and they enjoy that. So I'm a believer in that end. We actually have an ETF that we did where we've got like structured protection with, things that we do. It's like a structured note type deal because of that. It's to me, it's
explain that to everybody.
But I will say, to your credit, I think you need something like that because the barriers to entry for people starting these companies, that their business models are very esoteric, where they fit in. So I think, although everybody's saying it is a sustainable trend and there's all these reasons that it's good, I think people are paralyzed to figure out exactly which company to buy, how to invest in.
How do I do
think
it?
I think the buffered stuff they're doing is interesting.
Yeah, it's interesting. So basically, you're buying an ETF that basically buys a government bond that at the end of 1 year, you're going to at least get your money back minus the expense ratio, which is 69 basis points. You buy the government bond. We buy an option, and we have to sell a call to pay for part of that option. So you can get like about maybe a 10% return. If Bitcoin goes up 8%, you get 8. It goes up 9, you get 9. It goes up 10, you get 10. It goes up 50, you get 10. But if it goes down, you get your money back minus the 69 basis points. Now, you could also do it with 90% protection and get maybe 30. You could do it with 80% protection and maybe get
It's like a
50.
Bitcoin annuity.
Sort of, kind of. But it's not an annuity in the sense that you could sell it any day you want, right? So it's a bit weird, but here's the upside. I don't know about you. My problem with buying Bitcoin is you got to get a digital wallet. And I have to change my password on half my websites every 3 months. Like, did you forget your password? Yes, I did. And so if you have a digital wallet, heaven forbid I pass away and my wife is like, oh, Scott, you idiot. Like, it's $1,000 sitting there. I don't know, yeah. So it's like a safer way. So to me, if I was to go in Bitcoin, I'd go through something else as opposed to having a digital wallet, but that's just me.
That's why we tell all of our clients to write out all their passwords and attach them to their estate document.
Yeah.
Just a little planning tips.
There are custodial services for your digital wallets.
That's probably,
and there are a lot of them. And that's where I do think, though, I had somebody come and pitch one to me, and but then you've got Fidelity and Schwab that will also custody them. And so I think that's where people get a little paralyzed.
It's funny because does
that make sense?
It tries to break down traditional finance, and then it ends up making that you need traditional finance.
Absolutely.
Right, it goes right back there.
Yeah, exactly.
May I follow up on just one fundamental topic was interest rates?
Sure.
You said arguably there are so there's arguably room to drop a little bit. Our economy is doing well. So key unemployment rate is really low, 4%. Read about the EU dropping rates. I have a lot of family in Germany. Germany is struggling.
They're at 2, yeah. They're at 2 right now.
Yeah. So they're having a tough time. Our economy is doing better. Our interest rates have the power behind them to be higher. Politics aside, why would we reduce rates?
I agree with you. Look, 10 years ago, the cost of borrowing was nothing, and that's what everyone says, well, that's what it should be. No, that's just like a recency. Yeah, exactly. 10 years before that, the real borrowing cost was like maybe 1% real. 10 years before that, it was maybe 2%. 10 years before that, it was like 3%. So everyone just says, well, like, hey, Happy Days was like, yeah, we want to go back to that. I agree with you. I don't think we really need to. Money should cost something. It should. But we have a massive deficit, and we did not refinance our deficit when we had very low borrowing costs, and we should have. And I think the current administration's going, let's lower it and see what we can do. I think that's why.
The debt service has gotten really high.
Yeah.
Well, thank God. This has been great.
Thank you very much.
Thank you guys for coming.
Thank you.
It was great.